My name is Miriam, and I am 57 years old. I spent 18 years as a certified public accountant, specializing in small business tax, partnerships, and entity structure. The work that happens before a business is officially formed, the decisions about ownership, liability, documentation, and the work that happens after, when those early decisions either protect people or fail them. I know what an operating agreement is. I know what percentage ownership means in a limited liability company and what it means when that percentage is not in writing. I know what a buyout clause does and what happens when there is no buyout clause, and I know the difference between a business asset and personal property and exactly how that line can be moved by someone who knows the rules. I knew all of this. My husband James and I built a catering business together for 11 years. My financial systems, my tax strategy, my client billing structure. His name on the LLC registration because he was going to handle the legal setup and I trusted him to do it correctly. His name as the sole registered member because we were going to add mine, and we never got around to filing the amendment. When we divorced, he told me the business was his. He produced the LLC registration. He produced 3 years of tax returns that listed him as the sole member. He had, in the 11 years of our marriage, been careful, whether deliberately or through the same drift that lets paperwork slide, to keep my name off of every official document. What happened next is not a story about divorce, though divorce is in it. It is a story about a woman who spent 18 years understanding exactly how business ownership is documented, who understood that documentation and reality do not always match, and who knew precisely which records could prove the difference. Welcome to Calm Drama Stories. My name is Miriam, and this is the channel where what you built over a career becomes the instrument of your own protection when you need it most.
Subscribe.
Drop your city in the comments. This story starts with a divorce filing and ends with a business valuation settlement, and between those two things is 18 years of accounting knowledge and a paper trail I had been building for 11 years without knowing I would need it. Let me tell you about James and about the business. James was a good chef. That is true, and I want to say it clearly because what came after is complicated, and I do not want to simplify him into a villain when the honest accounting is more nuanced than that. He was talented, charming with clients, skilled in ways that I am not. The food was his. The business was both of ours. We started the catering company in year 3 of our marriage.
He cooked.
I managed every financial operation. The bookkeeping, the tax filings, the payroll system, the client invoicing, the vendor accounts, the quarterly estimated payments. I built the pricing model. I negotiated the equipment loans. I identified the tax elections that saved us $14,000 in the 3rd year and $22,000 in the 5th. The business grew from $80,000 in year 1 to $620,000 in year 10. That growth was not accidental. It was the product of 2 people's work, his in the kitchen and at the client table, mine in every financial system that made it possible to scale. His name was on the LLC registration. His name was on the business bank account. My name was on the tax returns as the preparer, not as an owner. I had flagged this twice. In year 4, and again in year 7. He had said yes, we should fix that, and I had drafted the amendment and it had not been filed. I do not know, to this day, whether that was deliberate. I know that it was consequential. When James told me he wanted a divorce in year 12 of our marriage, the first thing he said after that was, "The business is mine. It's in my name. The LLC is mine." I did not respond to that immediately. I sat with it for 2 days. Then I went to my home office, where I kept meticulous records, and I began to build the file. An LLC's official documents say who is the registered member. They do not say, by themselves, who performed the work that created the business's value. They do not capture who built the systems, who filed the taxes, who made the decisions that determined whether the company grew or contracted. What captures that is everything else: emails, invoices, internal financial records, tax work papers, bank correspondence, vendor agreements, the specific footprint of the person who ran the financial operations of a business for 11 years. My footprint was everywhere. I had 11 years of emails from my address to vendors, clients, the bank, the payroll processor. I had 11 years of tax work papers in my accounting software prepared under my preparer ID, with my professional credentials on every filing. I had the original pricing model I built in a spreadsheet, timestamped in my files from year one. I had correspondence with the equipment lender from year two, negotiated by me, in my name as the company's financial officer. I also had something James had not thought about. I had the QuickBooks file. 11 years of transaction data, categorized by me, with a user log that showed my login as the primary user for the entire history of the company. I called my divorce attorney, a woman named Patricia, who had handled complex marital asset cases for 20 years, and I walked her through what I had. She said, "How thoroughly can you document your contribution to the business operations?" I said, "Thoroughly." She said, "Then we argue marital asset. The name on the LLC registration is not determinative of ownership in a divorce proceeding. What matters is whether the business was built during the marriage using marital effort and resources." I said, "Every year of it." She said, "Then we proceed. In a divorce, a business started or significantly grown during the marriage is generally considered a marital asset subject to equitable division, regardless of whose name is on the formation documents." James's attorney knew this. The question was not whether the business was a marital asset. The question was what it was worth and how to calculate my share of that value. James's position was that the business was primarily valuable because of his culinary skill, his personal goodwill, which in most jurisdictions is not divisible as a marital asset because it attaches to the individual and cannot be transferred. He argued that the enterprise goodwill, the part that could be sold or transferred, was minimal, and that my share of the marital value was correspondingly small. This is where 18 years of small business accounting became the specific instrument of my case. I understood the distinction between personal goodwill and enterprise goodwill because I had been helping business owners understand it in tax planning contexts for my entire career. I knew what created enterprise goodwill: customer relationships documented independently of the owner's personal relationships, established systems and processes, a brand with value beyond any individual, recurring client contracts. I also knew that I had built most of those things. The client billing system was mine. The vendor relationships were mine. I had negotiated them. The client contract templates were mine. The systems that made the business scalable rather than dependent on any one person's presence were mine. I prepared a document, not as an attorney and not as a party to the divorce, but as a CPA analyzing a business I had operated for 11 years, that distinguished between what James brought that was personal and what the business had that was enterprise. I gave it to Patricia. She gave it to the forensic accountant she hired for the valuation. The forensic accountant agreed with my analysis on the central point. A significant portion of the business's value was enterprise goodwill, built through systems and client relationships that existed independently of James's personal skill. That portion was a divisible marital asset. The business was valued at $890,000. The enterprise goodwill portion was assessed at $410,000. James's attorney pushed back hard. They argued that the systems and client relationships I described were built by James's reputation, not by my financial management, and that separating enterprise goodwill from personal goodwill in a chef-driven catering business was not supportable. Patricia presented the paper trail. 11 years of it. The emails from my account. The vendor negotiations. The pricing model. The QuickBooks user log. The tax work papers. The equipment loan correspondence. She also presented something I had not initially thought to use: 5 client testimonials, gathered with the help of our mutual attorney, from long-term catering clients who described what kept them returning. 3 of the 5 mentioned the billing process, the reliability of the invoicing, the professionalism of the administrative side. One client said specifically, "I've worked with chefs who were more talented but whose businesses were chaotic. Yours was the most organized operation I've encountered in this industry." That was my work they were describing. The mediation lasted 2 days. James's attorney, in the second afternoon, came with a revised offer. The settlement was a buyout. James would purchase my interest in the marital share of the business's enterprise value. The number we settled on was $195,000, payable over 3 years, with the first payment due at the close of the divorce proceedings. What I want you to know, if you are building something with a partner and your name is not on the documentation, is this: put your name on the paperwork. Today. Not as a future project. Today, if you are a co-founder or co-owner of any business entity, your name should appear on the operating agreement, the LLC registration, the business bank account. If it does not, you are depending on trust to protect an interest that the law will measure by documentation. Trust is not nothing, but in a courtroom, documentation is what a judge can see. If your name is already missing from the documents, begin building the secondary record immediately. Email correspondence from your address on business matters, documents you authored that are timestamped and saved, any record that shows your operational role. The official documents say who is registered. Everything else says who did the work. In a marital asset dispute, both matter. One action. Today, if you operate any business with a spouse or partner, pull out the formation documents and find the ownership section. If your name is not there, make an appointment this week to have it corrected. The amendment takes one filing and a fee. I know because I drafted mine twice. The second time, after the divorce, I filed it immediately. My name is on every document of the consulting practice I started after. It took 20 minutes and cost $40. The absence of it, 11 years earlier, cost 2 years of litigation. The catering business still operates. James runs it. I am told it is doing well, which I believe. The food was always good and the systems I built are still in place, which means the operations are still reliable.
I feel something complicated about that.
Not quite pride, not quite grief. The particular feeling of seeing something you made continue without you. I have a consulting practice now. It is smaller and quieter and entirely mine, my name on every document, my entity, my decisions. I advise small business owners on entity structure and financial systems and tax strategy. And I tell every single one of them in the first meeting before we discuss anything else. Make sure every person who builds this business is documented as an owner from the first day. Not because you don't trust each other, because trust and documentation are not the same protection, and you will need the second one on a day when the first one isn't enough. They listen. I know because I have been the person who didn't know what your name is on. That is everything.